Good morning, everyone. It's January 25th, 2016. In this week's video, we'll review the price action for the Spiders ETF and the USO. We'll take a look at the historical chart of the S&P 500 and draw upon a few similarities and differences of the price action we've witnessed over the last 12 to 13 months versus that of 2008 and 1998 to draw on possible outcomes or new outcomes rather, to see if anything has changed as far as what markets may do, in the near and far future. And finally, I'll share with you a few charts that relate the stock market relative to the size of the economy to see if that gives us again any clues as to what to expect over the next few weeks, months, and potentially years. But first, let's take a quick look at the Spiders ETF. This week's long lower tail or long lower shadow confirms the trend we've seen really again since the beginning of 2015, that being that there are willing buyers stepping in at lower prices on the index, call it between 1810, 1820 S&P 500 all the way up to about 1880, 1890. But then once the index sort of trades above one of the minor pivots to the current range at 1920, those buyers quickly dissipate, and really higher market prices are a function of short sellers who again got trapped at lower prices. The most obvious question anyone can ask themselves is how long can this persist before um, sellers take command of the market profile and essentially cause a bigger rollover. And the second question is, if the market is in fact ready to trade higher, be it in the first, second, third quarter of this year, at some point this year, why did it take so much for the index to sort of show its true colors, or markets rather, or bulls rather, excuse me, to show the true colors and rally markets higher? Unfortunately, I think we don't have enough information as it is to sort of answer those questions truthfully. I mean, I can come up with various ideas and sell it as a fact, but it wouldn't be the truth. So, and wouldn't really truly help us to identify the key market trends that will drive future price activity. So, because of that, I mean, it's completely pointless, at least for the purposes of this video, to do that. So, the fact that markets again sort of broke below the August and October lows, but quickly reversed by the end of the week to actually close at the highs again, shows there's no imminent threat as of yet of a severe breakdown. But again, the fact that or markets rather, have been range bound for so long does add supporting evidence that a bigger rollover is at hand, especially, and I mentioned this over the last 2 weeks, especially if markets have a tough time trading at or above the rising trend line that dates back to 2011. By all means, you should continue to use this rising trend line as a sign of relative strength or weakness, at least in the short and intermediate time frames. However, if over the next, say, 2 to 4 weeks, so we'll call it by the second to third week of February, if markets are hovering at the lower range, at the lower sort of quartile rather to the current range, that being below 189.79 and all the way down to 1810, then perhaps that would be enough fuel to sort of again spark this bigger rollover that many investors are anticipating will happen, but don't have sort of a firm grip as to when it will happen. Again, for me to turn mildly bullish, at the very least, I need to see 189.30, 189.79 hold throughout every week for the next, again, 2 to 4 weeks, for me to remain somewhat optimistic. And it doesn't necessarily mean I'll be bullish. It just means, again, it means that there's enough buying at lower prices, enough to sustain any selling that may be forthcoming. But to really ignite a sort of rally that points to a retest of the current 52-week high, only to see the index trade above these two fib retracements, the 38.2 fib retracement price between 193.57 and 194.37, which if you go across space, it'll match another important fib retracement, the 76.4 fib retracement, to the extent of the entire range. Again, that dates back from the 2009 low to the present high at 193.56. So if those levels are sort of reclaimed, then that would sort of begin to turn the tide, but only a trade above the current pivot point at 246 spiders would again sort of make me a bit more bullish than I would otherwise be at lower prices. But even with that, even if the S&P or the spiders rather manage to trade back above 246, the only way that rally will be self-sustained and lead to a breakout eventually is if, again, 206.33 spiders gets reclaimed once the pivot gets contested and reclaimed, of course. If you look, so that's on the weekly. If you look at it daily, the most problematic thing I see is that these lows, or really the move you saw from Wednesday to Friday of last week, it was mainly characterized by gaps. Friday's monumental gap of 25 to 30 points is encouraging based on the fact that throughout the day there was a fairly compressed trading range where you saw the S&P trading in the 10 to 15 point range. Now, on any normal day, that would see like a fairly wide point range. But given recent volatility, 10 to 50 points in the S&P 500 is minuscule. It's not really that much of a move. The problem is, again, that more often than not, over 80% of all gaps created, doesn't matter if it's on the hourly, daily, weekly, monthly, whatever, 80% of gaps over time get filled. So it behooves the investor, the cautious investor anyway, to readily assume that the gap we saw on Friday will at one point or another be closed. Again, the main question is, when will the gap be closed? Is it going to be filled today, Monday, Tuesday, Wednesday, or is it going to take a few weeks or even months? And depending on when the gap gets closed, it's going to change the entire structure of the market. But by then, if you're waiting to see if and when the gap gets closed, you'll miss a good chunk of the move. But nevertheless, it's something you have to keep in that back of your mind. You could sort of write it down on your notes if you take notes, and say, on this day there's a gap, unfilled gap that needs to, that I need to sort of pay attention to, and just sort of keep it in the back of my mind as a potential catalyst to short-term price activity. Really, that's more to the point, more of what I'm trying to get across. Just be mindful of it. For this week, if the S&P trades back below 186.48 and 184.57, which is the big support line to this lower range, if that gets taken out, you have to, if you have some long positions, you have to sell them and sit on hands. But I wouldn't necessarily want to take short the market just because there's so much noise on the daily time frame that I need more information to truly make a sound decision of where markets may head. If the market trades below 184.57 and that's sort of what ignites the spark for a much bigger rollover and they miss it, I'm perfectly fine, because again, it's not the type of trade that I necessarily understand, and there's no reason for me to trade something that I don't understand just because I need to place a trade, or just because the majority of the crowd seems to be leaning in that direction. So for this week, again, if 186.48 and 184.57 get taken out for a second time, being that this is the third retest on a broader time frame of the current lows, the 52-week low that is, then again, that's extremely problematic, and more likely than not, it will lead to a bigger rollover. How big? Most certainly at least down to 178 to 180.57 spiders. On the other hand, if the rising trend line priced this week at 189.85, which is basically in sync with this fib retracement, the lower or the last fib retracement to the present range, then again that would sort of, it wouldn't confirm as of yet that the lows are in, by no means, but again it would sort of stymie any potential decline for the next few days or weeks. Um, if you look at oil, we'll take a look at the daily. Last week I mentioned how if oil, or the USO rather, took out 913 to the upside, I would contemplate the possibility of taking a bet on oil to the upside, even if it's for a day trade. Friday's close at 927 certainly piqued my interest, but as of today's open, it seems like the USO is trading back below 9, or roughly at 9. I'll give it a few more days to see how interested market participants are to hold oil above $30 a barrel, be it in Brent or WTI, and how much of the last week's rally in most equity names sticks. Again, if I had to sort of divide the good and bad from last week's price activity in oil, bad news is that every name in oil bounced as the commodity experienced a short covering rally. More often than not, when everything bounces, even names that shouldn't bounce, because even if oil trades at $30 or $35 a barrel, half of these companies are operating at a economic loss. When I see those sharp reversals from bottoms, right, or uncontested bottoms rather, it more often than not points to a relief rally at hand rather than a bottom in place. You only get meaningful bottoms placed when, there's a few things that need to happen. The two biggest things you sort of want to focus on is the commodity, or the underlying, that sort of, or the underlying that everything is sort of hinged upon, right? In this case, crude oil. When that bottoms first and leads equities higher, then that is your first indication that a bottom may be in. It doesn't, again, confirm it by itself, but it's one of those indications. And then once you get that sort of rally effect in the underlying, only equities that again are sort of cash rich, have strong balance sheets, don't necessarily have to access debt markets to finance current and future operations and whatnot. Only strong names that rally in sync with the underlying sort of confirm of a bottom being possibly placed or in the process or in the making. So because we haven't really seen either of these two characteristics as of yet, I'm hesitant to buy crude oil just yet. I mean, for a day trade, could it work? Yes. For this week, as long as we don't trade below 880, 875 on a daily and or weekly closing basis, not intraday, just daily or weekly, I might again consider the possibility of entering the trade only above 913 for that trade up to $10 roughly on the USO. But again, there's nothing to be sort of bullish about on crude oil, given how fractured and broken the daily, weekly, and even hourly chart. I mean, yes, this week's hammer on the weekly time frame is encouraging, but again, it's not enough to sort of indicate that a bottom is in. If we now take a look at the historical chart of the S&P 500 and sort of drawn up upon a few similarities and differences, we'll notice a few things. Most people think that the market today is very similar to that of 1998. And in many respects it is. But if we were focused on price alone, I would argue the S&P 500 today is much more, resembles that much more, the market much more of that of 2008, excuse me. The reason I say this is because, from price perspective alone again, and you believe in market symmetry as being efficient, which I do, then you'll notice that, back in 2008, this market spent 245 days, roughly speaking, plus or minus 10 days, consolidating a range before breaking down, consolidating, spending an additional 238 days at the lower range before essentially giving way to much lower prices that essentially, led to the financial collapse, right? That's the duration in days. As far as the percentage moves, the initial consolidation phase was of roughly 10% in the S&P 500, while the latter, or the second consolidation phase, which proved to be distribution, was of 17%. So we rely on market symmetry. The fact that we're consolidating the index back in 2015 for roughly 273 days, comparable again to the first consolidation phase that took place back in 2007 of 245 days, which was then followed by a severe breakdown, right, leading to a second consolidation phase at a lower price band. Again, very similar in duration as far as time is concerned. And one could argue that the market could consolidate at the slower range, call it between 1830, 1840 S&P 500, all the way up to 1940, up through May, possibly extending up to through June of this year before and if a breakdown of much bigger magnitude is in order. Now, what could possibly, again, just from assuming markets are perfectly symmetric, how big of a decline could the S&P 500 sort of sustain if, in fact, the same sort of cycle is in effect today? Well, again, using market symmetry, that would point to the S&P 500 trading as low as 1670 initially, at some point again, beginning in May and lasting up through October. So while I don't, again, I wouldn't place any trade just on market symmetry alone, namely because the economic cycle and the market cycle we are in today are much, much, much different than that of 2008. It's still something to sort of, again, keep in the back of your mind because it could very well be a possibility, especially if, and that's a big if, markets do in fact consolidate at this lower range for the next 2 to 3 months. And the two charts I want to share with you, the first chart sort of relates the total value of equities relative to the economy, and by that measure, market cap to GDP, and by that measure, markets are still quote unquote expensive. This is one of Warren Buffett's most commonly used metrics as a way to gauge how expensive or not markets are. And if you rely on this, if you believe in this sort of metric, which has its own flaws, but if you believe in it, then markets are still, even with the decline, considered expensive. And then if you look at something like leveraged financial speculation in relation to the economy or margin debt, right, relative to GDP, you could also make the argument that markets remain expensive and highly levered. And this is sort of risky in the current environment, given how the carry trade, which has essentially been sort of the mechanism by which different hedge funds, investment banks, and whatnot have essentially funded most of these trades. You can make the argument that this high ratio of margin debt to GDP ratio is also emblematic of a weakening market that is set to roll over. Now, the main difference, and I think this is again the most obvious thing to the naked eye, is the fact that back in 2000 or 1999 and 2008, when margin debt to GDP rose above 2.5%, you saw a sort of a brief trade above 2.5%, as high as almost 2.75% before a bigger rollover led to the decline. This time, however, margin debt to GDP has actually been sustained at higher prices. We haven't seen, after that initial print above 265, 270, we haven't seen that immediate rollover, which speaks again to the different market cycle we're in today. So if you were to ask me, I don't think margin debt to GDP, or even viewing markets from the prism of market cap to GDP, and saying that just because these two metrics are sort of warning of a market that continues to be overvalued, that those are sort of reasons for the market to roll over. These, more than anything, are backward-looking indicators, and again, they don't really apply to the markets today because we're in a completely different environment. Yet everyone likes to use conventional tools that worked in the past to gauge a market sentiment and market price, but that you can't do that anymore. That simply does not work. It does give you a sense and an idea of what markets may do, but to rely on these heavily, I think, is a major mistake. Does that mean the markets can't roll over? They certainly can, and most certainly, like every time market, they most certainly will, and the market being as unpredictable as it is in certain ways, it will surprise most of us, be it up or down. So could a rollover happen? Yes, but if it does happen, I think it won't be because of these two reasons. Some people, sort of in the blogosphere and the media sphere, call it what you want, are sort of citing as reasons why markets need a rollover. So hopefully this weekly video was of use. Again, I didn't share many specifics because there's so many unknowns that I think we have to give. We have to sort of be at this point in time. You have to be a market observer more than anything. I mean, yes, you can day trade different trends that you see fit to the upside or to the downside, but I think the next few weeks, those that are closely observed markets are going to be rewarded in time, more so than those that day trade out of from sort of day signals. I guess you can call it. But in any case, we'll see what this week's brings. Oil is again critical for for what the market does short term. There's a Federal Reserve meeting this week. That is definitely a catalyst, whether again for good reason or bad reason, but it's going to be a catalyst for markets this week. And then we have a sort of swath of earnings reports from heavyweights like Apple, Amazon, Microsoft, and the like, and also from a few major oil companies like Halliburton, Chevron, that will report earnings. So we'll get a much better idea of what the state of corporate America is, and I think that will sort of define again the first half of the year that we'll have in markets. So I want to thank you for taking time to watch the video, and I'll talk to you next week.